Welcome to the Explainer. Okay, if you're working in the construction sector, you already know there's more than enough red tape to go around, right? But today, we're demystifying something that is literally flipping the script on how VAT is handled. It's called the domestic reverse charge. This rule, it's a real game changer. It completely transforms your administrative burden, your cash flow, the whole shebang when it comes to invoicing. So we're going to clear up the confusion right here, right now, and make sure you know exactly how to navigate this massive shift.
Look, tax law can be super stressful. I completely get it. But as you can see on our agenda, we're going to break this down logically so you can stay fully compliant with HMRC. We'll look at what the reverse charge actually is, who it affects, the very real impact on your cash flow, how to handle your invoicing and VAT returns, plus those tricky exceptions and special rules. Finally, we'll wrap up with the bottom line. Let's jump in.
All right, Section 1, what is the reverse charge? Subtitle, Flipping the Script on VAT. Let's get right into it.
So to start off, we really have to look at this massive shift HMRC introduced. Why did they do it? Basically, to combat fraud in the construction industry scheme, or CIS. The domestic reverse charge, or DRC for short, is at its core an anti-fraud system. But on a day-to-day level, the impact is huge. It shifts the responsibility for accounting for VAT directly from the supplier to the customer in these construction transactions. Think about that for a second. The responsibility is literally lifted off the person doing the work and placed squarely on the shoulders of the person receiving it.
It's a totally flipped dynamic, right? I mean, under normal rules, you do the work, you charge the VAT. Simple. But under the DRC, if you're the supplier, you actually do not charge VAT on your relevant supplies at all. I know, it feels totally counterintuitive. Instead, the buyer has to account for that VAT themselves on their own VAT return. It's a fundamental change to how businesses have to manage their VAT from the ground up.
Moving right along, we've got Section 2. Who does this affect? Identifying your role in the supply chain. Now, the plot thickens here because you need to know exactly which bucket your business falls into. Let's take end users, for example. Think of a property owner getting a new roof. If your business is registered for VAT and CIS, but you aren't turning around and resupplying those construction services onwards, you're an end user. Normal VAT rules apply to you. But, and this is a massive catch, folks, you must notify your supplier in writing that you are an end user. If you forget to notify them, bam, the reverse charge hits you by default instead of the normal VAT rules.
So, let's ask an absolutely critical question for those of you caught right in the middle of the supply chain. Are you an intermediary supplier? If you're the middleman, pay close attention to this. To be classified as an intermediary supplier, you've got to be VAT and CIS registered and buying and resupplying services to a connected end user. Now, what makes you connected? Well, you either need a relevant interest in the exact same land, like being a landlord or a tenant, or you're part of the same corporate group under the Companies Act 2006. Interestingly enough, intermediary suppliers actually have a choice here. They can opt to be treated as end users. But again, to make that happen and stop the reverse charge from applying, they have to notify their suppliers in writing. It's all about that paper trail.
Okay, misclassifying your workers here is pretty much a fast track to hefty HMRC penalties, which nobody wants. Check out this table. If you're a labor-only subcontractor falling under the scope of the CIS, the reverse charge applies. Period. End of story. No VAT on your invoices. However, if you're an employment business, the reverse charge does not apply because you're treated as supplying staff, not construction services. Getting this specific distinction right between supplying labor versus supplying staff is absolutely critical to staying compliant. All right, let's move into Section 3, the cash flow impact, the financial reality for subcontractors. Okay, we are now at the absolute most critical part of this explainer when it comes to your business's health, your cash flow. £0. Yep, 0. That number represents exactly how much VAT a subcontractor is going to receive directly from their customers under this new flipped rule. I mean, really think about the real-world impact of that 0. Because you aren't collecting that VAT anymore, you are looking at a significantly reduced gross cash inflow hitting your bank account. That immediately translates to less working capital available for your day-to-day operations. It makes immediate cash flow planning not just a good idea, but essential for survival. But here's a pretty great strategic workaround. Since you're paying VAT on your purchases but not collecting it on your sales, you might find yourself in a repayment position with HMRC. So definitely consider applying for monthly VAT returns to get that cash recovered quickly and keep your business breathing. And that brings us to Section 4, Invoicing and VAT Returns, the administrative execution. So, how do we actually execute this new rule without, triggering a bunch of non-compliance penalties? Well, it starts with the invoice itself. Suppliers have to show the net amount and the VAT rate, but remember, you don't actually charge the VAT. Most importantly, and do not forget this, to be compliant, your invoice must include one of these exact phrases: reverse charge applies or customer to account for VAT. It really is that simple, but leaving it off, that dramatically increases your risk of trouble with HMRC. The domestic reverse charge really turns this into an accounting-only process. Suppliers report their net sales only, while customers have to report the output tax and, if they're eligible, reclaim it as input tax. But man, this creates a massive ripple effect on existing tax schemes. You absolutely cannot use the VAT cash accounting scheme for transactions falling under this new rule. No way. And if you use the flat rate scheme, your DRC sales must be excluded from your turnover calculation entirely. Because of this, a ton of construction businesses are going to have to review and overhaul their accounting methods.
Now for Section 5, Exceptions and Special Rules, Mixed Supplies and Unique Contracts. Because let's face it, real-world construction is rarely simple, right? Often, you're supplying both goods and services under one single contract. Normally, this is treated as a single supply, and the reverse charge would apply to the full invoice amount. But there is an exception. If the reverse charge element is just a minor sliver, and by that I mean specifically 5% or less of the total contract value, you can disregard the reverse charge element entirely. You just apply normal VAT rules to the whole transaction. It's a nice little carve-out there. You've also got to watch out for some highly specific, unique scenarios. First off, don't try to artificially split invoices just to avoid the rules. HMRC will see right through that. What about snagging work? That is generally going to be subject to the reverse charge. Design and build companies. They might actually qualify as intermediary suppliers. Scaffolding is a really tricky one. The VAT treatment there depends strictly on how your specific contract is structured. And finally, utilities and public bodies are almost always treated as end users, which means the DRC won't apply to them at all. Ultimately, the specific context of the work changes everything, so you have to look closely at every single contract. And finally, we arrive at Section 6, the bottom line: taking control of your VAT compliance. All right, we've covered the what, the who, and the how. To successfully navigate this extra administrative burden, you've got to take these 3 steps immediately. Step 1, verify your customer's exact status and get the proper documentation in writing. Step 2, plan your cash flow today to prepare for those reduced gross inflows we talked about. And step 3, update your administrative systems and invoicing formats right away so you aren't caught off guard. Get ahead of it. So, before you send out your next invoice or file your next VAT return, I want you to ask yourself one absolutely critical question. Is your accounting software actually ready to handle the domestic reverse charge automatically? Seriously, getting the VAT treatment wrong here could leave you directly liable for unpaid VAT coming right out of your own pocket. You might think you're totally prepared, but what hidden supply chain links in your current projects are about to trigger an HMRC audit? Definitely something to think about. Thanks for joining me for this explainer.
If you are looking for professional guidance, give us a call today. Sit back and relax while we do all the complicated work for you.